So today, and one of the things that's nice about being in a smaller group, I'm going to move. We'll be able to talk. Jim will have a microphone also, but it's a nice size room to be able to move about. So I will plan on doing that. What we are going to be doing today is talking about the IRS's goal for non-filers. We're going to talk about their current emphasis, which is on high-income non-filers. I have a little bit about that. We're going to talk about what you need to deal with if you have a non-filer, because sometimes it's just doing the tax return, and sometimes it's more than just doing the tax return. So we'll have a little bit about that. And we'll talk about those people who are non-filers, or those of you who have business owners who don't have good records, because there's a cross on that. What you need to do for a non-filer, you can utilize also when you're dealing with your business owners who aren't so good about keeping track of their records. And that's a lot of them, right? Especially those small guys who are really good at what they do, but they're not necessarily so good about tracking. They don't quite understand it. They don't know what a general ledger is. They don't really get what we are talking about when we need the information we need for a tax return. And I saw a question on one of the Facebook boards today where somebody was saying, for a Schedule C, do you require like a full-on general ledger? How many of you require a full-on like QuickBooks or Xero or one of those general ledgers? Or will you take an Excel schedule if you're lucky? Or will you take something that's just handwritten piece of paper? You're going to take what you're going to take, right? It's going to depend on the taxpayer. So if somebody's capable of doing all of the record keeping, they're probably not a non-filer. It's the ones who aren't capable of doing all of that, who didn't file last year or the year before or the several years before that. So I want to talk a bit about the current IRS environment, because we may be in for the nastiest filing season that we have encountered in 40 years. So I happened to be at the NYU conference that was done in New York City in June, and Terry Lemons, who was the communication director for IRS, he is now since retired, was talking about what the IRS is facing at this moment. They had, this is in June, late June, before OB3, which passed just like the following week. So he was giving a snapshot in time. 37% budget cut. We already know that's bad, right? Then they had had a reduction of 25% in workforce. What has happened since then? More, right? So we have less people. They've lost senior executives. And what he's saying is they've lost them at the first couple of levels, which means training is impacted for those people underneath it. So the loss is, you may think, who cares about a senior executive? But who's going to train the people that we're going to be dealing with? The people have experience, and they are not there anymore. They took the downsizing. They took the early out. They did what they could. And then you had OB3, which passed after this conference. So they were describing the perfect storm for the worst filing season since 1985, coming up in January. How many of you want to retire? Like right now. I'm in, let's talk about it. I don't know who's going to take over our practices, but I don't even want to give referrals anymore. I'm just thinking, could this be the year? It could be, because we are coming to something that could be very, very ugly. And so what they were talking about is there's this belief already, there's nobody at the IRS, so who cares? Who cares how you file? Who cares if you tell the truth? Who cares if you file? Well, there's still somebody there to care, right? We hope. The IRS is used to doing a lot with very little. We've seen that for a number of years. But now they were saying they may be forced to do a little with a little. So I am always careful to be respectful and kind to people I work with on that side, because I've believed always you need the IRS and you need us. That's what our system is about. So I don't believe in, LG and I have had some differences of opinion in how you deal with people at times on IRS side, but I think you need to be compassionate, perhaps a little kind to what they're facing too at this point in time. It will maybe get you a better resolution than coming in too strong and hot, if you're lucky enough to get somebody on the phone. Wouldn't that be lovely? So just know this, as we are coming into it, we could be in for some rough weather here. So this was as of May. We have now had months go by. The information for these classes is due in August, so things have occurred even since then. But this is some current snapshot about what was going on. Again, 25% gone. We're going to focus on individuals. You know that businesses can also be non-filers, but we're going to talk about individuals. And the basic story on this is they become a non-filer by just not filing a return. Could be one, it could be more than one. So sometimes you have somebody who's just a habitual or repeat non-filer. Sometimes you have somebody who skips some years and then files in others. Maybe they have things going on in their life. Or you have filers who filed consistently and then just stopped. Now, I like to know why they stopped. So we're going to talk a little bit about why. I've had elderly people just think that once you're 65, you don't have to pay tax anymore. I don't know where that belief came from, but okay, I'm all right with that. On one of the Facebook groups here not too long ago, within the last few months, one woman was saying, well, how do I convince my son that he has to pay tax because he's under the age of voting and he has no say in his representation? There anywhere in the code that it says you have to be eligible to vote to pay tax? No. It's income-based. And it's income-based on Code Section IRC 61. All income, whatever source derived, is taxable income. So she didn't like that answer. A number of us gave it to her. It's not age-based. It's income-based, right? And unless the tax code says something is not taxable, it is, and you need to file a return. We still have a voluntary system, but you need to file that return and you need to report the income. Some people refuse. They don't think there should be taxes. They shouldn't have to file, so they're just not going to file. Some people operate in the underground economy, which is still vibrant in many kinds of fields, and they don't have anything reported, so there's no reason to report to the IRS. That's just their preference, their belief, whatever. Others may just have a really, really bad year or two. They may be ill. They may be dealing with family members who are ill, divorce, all kinds of situations that get them in a place where they cannot deal with it. I have one taxpayer, he's been a client 20, 25 years. He just some years can't do it. He just can't. I don't know why, but he can't. And so we're still trying to figure out if he's going to get 24 together or not. He kind of skips a few years and then he'll catch up. Usually it's a refund, so it's not a big deal. But still, there's some people who are so afraid of the tax process that filing a return is just not something they can work themselves up to very often. Some intend, they'll get to it when they're ready. But they like their own every other year or every second year tax filing plan that just sort of seems to fit them. I had a guy that was like that for a number of years. He would file suddenly because ex-wife took him back for child support and he had to have a tax return. But then he would just skip until the next time she took him back to court and he needed to catch up on his taxes. I don't know. Some people know they're going to get a refund. They don't worry about the normal filing deadlines. And others have this erroneous thought that not filing the return is better because they know they can't pay it. And if the IRS doesn't know that they owe it, that's somehow better. You know it's not because you know the penalties, right? We all do know that. There is no statutory requirement for the IRS to notify taxpayers. In this particular case, which has now been around for a while, they sent their tax returns, 1996 tax returns, 3 times, twice an original, once a 1040X to the IRS in 97. None were ever received. In January of 98, the IRS did notify them that the 96 return had not been filed. The IRS did not get the 97 return. They didn't get the NOD, the Notice of Deficiency that the IRS sent them, so something's going on with their mail. They requested an abatement of interest because the IRS did not notify them in a timely manner that their returns had not been filed. Is there any such requirement? No, no. And an abatement of interest is certainly not going to come from that set of circumstances. Okay, so they did not win that one. Taxpayers have a non-delegable duty to file their return. And non-delegable means they can't say, well, it was up to Jim. He had my stuff. I don't know why he didn't finish my return. If Jim's the preparer, can he sign for the taxpayer? He better not, or I'll be seeing him in the ethics class, right? So you can't say, well, my preparer should have done it. That counts on an extension, too. It's not the preparer's job to file the extension. Yes, we can ask them to do it, but the taxpayer is still responsible for that. Now, when I first heard these facts, I'm like, well, why the heck did she think that the employer was going to be filing the return? The husband was in a foreign country, and sometimes employers will do the returns of people who have the complex situations that are caused by international tax. And in that case, she thought, well, they didn't file the return, so I can't file any others. Not quite right. And so she did not get away with that. She still, along with all other taxpayers, have to use reasonable care to determine that the tax return is filed or whether they need it. So you can't delegate your responsibility to file. There are a number of problems that can come out of not filing a tax return, right? Because there are certain elections that need to be made when you file a return, or that you may be unable to file a joint return, for example. And so not everybody knows this. Once you have filed a tax court petition, you can't necessarily file a joint return. Joint return is an election. So if you don't file the return prior to filing the notice of, or filing with the notice of deficiency in the petition, you're not going to be able to do it. You know, you might lose the Social Security credits because those are only available for the 3 years plus. So if you don't file the return, then they don't know the income. Tax returns might be required if you're going to refinance a loan or get a loan. If you are going to apply for student aid, you need an original tax return to itemize deductions. That also is an election to get IRS payment alternatives. And some of you, Dave, I know you're one of them, you've specialized a lot in collection work. There are others. How many of you specialize in collection? So you know that you have to file returns as part of that process, right? They want to know exactly how much you owe. Okay. So you need to be able to get the returns done. And it's possible, it's not likely, it's more likely that you could be subject to a penalty, a civil penalty. But under certain circumstances, a taxpayer might be subject to a criminal investigation or penalty for not filing their tax returns. It's possible, I've always wondered this, it's possible that you might have a higher audit rate. That's possible if you've got returns that have not been filed. And there is a certain program going on right now with IRS geared towards the higher income taxpayers. So that could be. I've always thought that a late filed tax return might be subject to greater scrutiny. That once you get out of that normal processing that occurs, especially if somebody has to hand process your return, maybe it gets kicked for that. And if you are working with government contracts, you have a compliance issue if you're not filing the tax returns. Non-filers are part of the tax gap. And you know the tax gap is the difference between what should be collected and what actually is collected. They're not the biggest part, but enough of it is coming from non-filing, $63 billion as of the last tax time that they did this in 2022, that there is a certain amount of attention going to be filed or looked at on non-filers. And non-filing, we know the 1099s that have been created, the whole series of 1099s reporting all the different kinds of income is trying to capture the income, right? Trying to make sure that everybody has their income reported as much as possible. IRS's goal is to get a voluntary tax return. That's what they want. They'd like you to pay it too. Don't misunderstand. They would like you to pay it also. But they want the return in, and then they will compute the tax penalties and interest. There is now a new form. Now, those of us in California, the FTB has done something similar to this for a number of years. And sometimes the IRS picks up on things that Franchise Tax Board does, and it's nice to see that happen because the FTB has sent notices like this for a while. It says, we don't have your tax return. If you mailed it or filed it, tell us. If you don't think you owe it, tell us. But they're tracking, okay, what happened to the tax return? So this is a form, and this was part of what they're gearing towards with the high income non-filer. All right, let's tell you you don't. We don't have a tax return for you. And let the taxpayer tell the IRS, yes, one's been filed, one's coming, or we don't know. We don't have a filing requirement. So has anybody seen this form? No, okay. It's come out in the last couple of years. Now they're showing 2017 on this, but I know the focus now is on more high filers or high income non-filers, so you will see perhaps some of this. Under Code Section 6020 of the Internal Revenue Code, the IRS can prepare a tax return for you if you don't prepare your own. So under 6020A, if the person for whom the tax return has been filed signs it, it becomes their tax return, okay? Just like any other tax return. That's not a big deal. The tax return is done. IRS does it. Taxpayer subscribes to it. The substitute for a return under 6020B is more the thing that you'll be dealing with if you're dealing with non-filers, all right? And under this one, if they fail to make a return or makes a false or fraudulent one willfully, the secretary can make the return from his knowledge or from other information that he can get, and they have the power to create what is called a substitute for return, or SFR. That's as good as a tax return. Taxpayer doesn't have to sign it. That's as good as a tax return. It's prima facie good and sufficient for all legal purposes, okay? So it can be created by an RO, ACS, or other collection function employees. It starts the 10-year collection statute, but it does not start the assessment statute until the taxpayer files a return. So they then have the 10 years to collect off of it, but it does not deal with the refund statute or the assessment statutes. It's generally not done when they can tell there's a small balance due. So if you look at a transcript and there's W-2 income and there was withholding, yeah, maybe not. If there's a lot of 1099 NECs and you can see that they have self-employment income, or if there are brokerage statements where it looks like there's capital gain, or there's other indications that there may be income that needs to be reported, then that's where they can use the 6020B. If you are due a refund, you have to voluntarily file the return. IRS is not going to do that if it looks like they're going to give you a refund. You have to do that, all right? And again, usually they will when it indicates there's a balance due or there's self-employment tax that is due. So the IRS will include on the SFR all of the income that they have reported off of the transcripts for the W-2s, the 1099 forms. They will calculate the SE tax. Okay, now I've seen them ignore the basis. Have you guys also seen them ignore the basis and only go with your gross sales? Yes. They're supposed to look at the 1099B that shows the basis. Doesn't always happen. So that's a reason when you might want to file a return too, to get the correct amount of tax that's going to be due by the taxpayer. Because even though since about 2011, 2010, somewhere like that, basis has been required, they're supposed to look at it. Doesn't always happen. So then you need to actually file the return, get the correct tax return on the books. Well, okay, so here's the thing. The question is about 1099-Bs that still come out without basis. If it's inherited, you may not have correct basis, or you may not have basis because it is based upon the law and transactions that occurred after that date. So if something was purchased before the date, then they may still have no basis, and you need to try to get that from the taxpayer, or use one of the resources that we would have available to do some calculations, right? Be paid to do those calculations, all right? Don't just do those out of the goodness of your heart. SFR returns, besides a 1040, these other returns can be done too. So if you're not filing payroll tax returns, they'll look at the last return of the quarter that was filed, bump it up, and keep bumping it up until they get an actual tax return. They'll do the same thing on a 940 for an annual. They'll just increase the amount and file the return for you. So a business that is not filing can have multiple issues going with other requirements, maybe an excise return or heavy vehicle use. If you have a question, I need you to raise your hand. I'm partially deaf, and so I'll either come to you, or if it gets to be too much, I'll ask Jim to run the mic, okay? Thanks. So the IRS, for the SFR, the IRS is going to send a notice to the taxpayer saying, okay, this is the income, the filing status we give you. Notice, we give you, because they are not going to give you the election of filing joint, and they are not going to give you your dependents, because how do they know, right? So if they do an SFR, you are going to be married filing separate, or you're going to be single, and you're going to have you, and that's it. You're not going to have anything else. You have to file the return correctly to fix whatever the other correct filing status or dependence might be. If the taxpayer doesn't respond, then they will move to a notice of deficiency. Notice of deficiency gives you generally 90 days to file a petition in the tax court, and then you can have the matter resolved by the tax court. Otherwise, you lose that time period. You lose that opportunity to go to tax court if they don't respond and file a petition within the 90 days. The taxpayer can still file a correct tax return anytime in that process, and the collection activity can occur if the filed return still shows a balance due. So we talked about notice of deficiency. If the petition is not filed in the 90 days, then the IRS is going to assess the tax and begin collection activity on it. If you are not admitted to the tax court, and I am aware of 2 of us who are, is there anybody besides PK and I who is admitted to tax court at this moment? We're the only ones who can prepare and sign the petition, okay? In order to represent before tax court, you are supposed to be admitted as either an attorney or a non-attorney. But they have a procedure in the tax court that will kick it back generally to appeals, and in appeals, EA, CPA can still represent. So there's still an opportunity to resolve it, but you may not be able to be the one signing the petition and getting that matter back. Without the petition, they can still file a correct tax return and get the amount done to where it needs to be. Any abatement by the IRS is voluntary after they assess. So you file an amended return, do they have to accept your amended return? No, they don't. And they can refuse to accept an original return also. So you have an SFR, you're trying to cure it, taxpayer wants to file a return. Think about this, if it's a frivolous return, are they going to accept that and get rid of the assessment they made? No, of course not. So they can refuse an original or an amended return. They can always refuse an amended return. But to fix the SFR after the 90 days, they can refuse the original return as well. Statute of limitations, generally 3 years. It goes to 6 years if you have an omission or understatement of gross income that exceeds 25%. That also counts on an overstatement of basis. If there is no return filed, if there is a fraudulent return filed, then there is no statute of limitations. So IRS can do this at any point in time that they choose to do it. There is nothing in the code that defines exactly what a tax return is, but there's this court case from 40 years ago, roughly, it was in the 1980s, I believe, called Beard. And in order for it to be a tax return that's going to be accepted, it has to purport to be a return. It has to be an honest and reasonable attempt to satisfy tax law, has to contain sufficient information for the IRS to calculate the amount of tax, and it has to be signed under penalty of perjury. So if a taxpayer is doing a fraudulent return, changing things to zeros, crossing out the jurat, it's not a tax return. This is what's required for an actual tax return. Know also that once a fraudulent return has been filed, it is always considered to be a fraudulent return, even if the taxpayer amends it later, and even if the fraud is committed by the preparer and not the taxpayer. It will always be marked as a fraudulent return. If the taxpayer fails to file the return, statute is always open. Yes?
For filers that receive K-1s, which they are not in control of when the pass-through files.
So the K-1 is going to be late?
Late past the October 15th.
Okay, so you want to know what to do with the return? Okay, so the question has to do, and we'll repeat it because they're recording this. So if you have a K-1, for example, or something that's going to come past the October 15th deadline, what do you do? Can you still file a return if you're missing information? Yes. What would you do if it's a significant piece of that return? You might make an estimate. And you might have to disclose that you've used an estimate on an 8275, but don't not file the return. Way back long ago, one of the first audits that I defended, the IRS, it was a guy actually who was a CPA who had gone to work for the IRS after he had been in private practice for a while. And he said one of the things that they told him that stuck with him, there are no perfect tax returns. Now, there probably are if it's a W-2, and that's all there is. Yeah, it's probably a perfect tax return. But because of interpretations with tax code and getting the correct information and somebody misunderstanding something along the way, we often have imperfect tax returns. So don't think you cannot file the return because you do not have a piece of paper. It might be a very insignificant piece of paper, in which case it's not going to make a difference. A K-1 might represent suspended loss. You can't use it. It's a passive loss. You can't use it. It may be something that didn't affect the tax return at all. It might have a significant piece of income off of a partnership or an S corp, for example. I would use an estimate. Did you have something, Betsy?
You mentioned before that if there's fraud committed by the preparer, that fraud remains on the taxpayer's record.
Yes.
Is there any way, or that obviously the taxpayer shouldn't have signed a fraudulent return, number one. But if is there a way to clear that?
Once it's fraud, it's always considered fraud, even if there's an amended return. So officially, the statute's always open. So even if the taxpayer did not do it, they still signed the return. Now, if they didn't sign the return and the preparer filed without their signature, is that a different situation? Then you have different facts.
Right.
But if they signed the return and they say, oh, I didn't know they put a business, I didn't understand what I signed, okay, I'm sorry you didn't understand what you signed. You know, I represented somebody who 60-some years old had, you're not going to be too surprised about this, had child tax credit on it. He didn't have a kid that age. And also had American Opportunity credit on it. He said, I wasn't going to school. I didn't know what they were doing. I tried getting him out on reasonable reliance, and it didn't work. So you can sometimes get a penalty abated if you were reasonably relying on your preparer, but they have to have been a competent preparer, and there were some other requirements, and I didn't get that one past appeals. But, you know, you have to look at the situation. Now, if you get a correct tax return in there filed, are they really going to come back after you 20 years later? I don't think so. But there's a court case on it. I think it's in your materials. I think it might be Allen. Doesn't matter who's fraud. All right, any other questions about statute? We all work with it. We all have a pretty decent idea on it, right? The IRS comes in looking for non-filers. And again, their goal is really to just get compliance, get the tax return filed. Let's find out. Let's get it paid too. That would be nice. But let's get the tax return in and filed. So you might be dealing with collection or examination employees. Lots of them will just be generated off of a computer. Won't be a real person they'll be dealing with anyway. They'll be getting notices. So you have revenue agents and you have revenue officer. And remember, the revenue officer is the one who can execute a 6020B SFR. Now, y'all know the difference between RA and RO, right? Because they don't like it if you don't use the right term. So an RA would be coming from examination. They are revenue agents. ROs come out of collection, and think O. RO, you owe money. That's where that's coming from. Otherwise, it's RAs. If you mix it up and you're talking to IRS, they will not like it. They will know that you don't know what you're talking about. So here's the problem with SFRs, and there are many, because the IRS is not going to give you the correct filing status, probably. They are not going to give you the dependents. They are not going to give you itemized deductions. They are not going to, if you are a self-employed person, they're not going to give you any business deductions either. They're going to prepare it based upon income and one dependent and single or married filing separate status. That's the way it's going to be. So you need to file the return to get it corrected with IRS. Rarely is the SFR going to be in the taxpayer's best interest for the reasons I just said. Wrong number of dependents, wrong deductions, no itemized deductions. Maybe if they have unreported income, maybe the SFR is better. We'll save that for ethics someday. Don't ask us on Tuesday though, okay? It almost always is that the SFR is going to have a higher balance due. And so one of the things we as practitioners want to do when you're dealing with a non-filer, especially one who has the SFR, is let's get the right tax return filed. So we know how big the problem is. Because once you do that, then you can start focusing on collection if the IRS is going to be able to come after anything on collections. This was an NBA player. He received an NBA pension. He had withholding. The SFR gave him standard deduction, one personal exemption. They also knew he was under 59 and a half, so on the pension amount, they gave him the 10% premature penalty, okay? But under Code Section 63, it's an election to itemize deductions, and he didn't file a return, so he did not make the election to itemize deductions, and you don't get those itemized deductions unless that. So he did not file a return. He doesn't make that election. He doesn't get the benefit out of it, and he paid higher tax because of it, even if they could see a 1098. Because does a 1098 really tell you anything other than mortgage interest was paid? Doesn't tell you who paid it or who was entitled to pay it. So he learned that expensive lesson. You also know that there's a refund statute, and that if you don't file a tax return, you might lose your refunds. So how long is that? How many years? 3 years. So if you do not file a return within 3 years, generally, there's always the exception about payments that were made that you have to look at, but generally it's 3 years after. So the claim for refund must be filed within 3 years from the time the original return was filed, or 2 years from the time the tax was paid, whichever is later. There is an exception for financial disability. We'll talk about that in a moment. That can be a mental or physical illness that lasts more than 12 months, or one that is expected to result in death. So I'm going to come back here and get a few more steps in for my day. Dave.
Does an SFR with self-employment income, net income, get reported to Social Security?
I don't think so. I think it's original returns. Do you know?
No, I don't know.
He's asking is if an SFR is reported to Social Security, and I don't believe so. I think it's your original return. That's why I said that you could lose your Social Security credits. Because unless you subscribe to that return, and you don't with an SFR, it's the IRS's return. Unless you subscribe to the return, it's not going to be filed and you'll lose those credits. As I said, that's one of the downsides to not filing the tax return if you're self-employed. All right, so let's take a look at this particular one because it clarifies the time frame. Again, it's a little bit old, but the concept is still good. Their 1999 return was filed February 6th, 04. They want to apply the refund to the balance due for 95 and 2000. The IRS said, nope, you're late. We're not going to do that. And he says, I moved 6 times, couldn't find the 1999 tax documents until 2004. Who cares, right? They don't care. Their withholdings, this is the part you need to know. A withholding for a year is deemed paid April 15th of the following year. So 1999 withholdings on W-2 earnings are deemed paid as of 4/15/2000. The refund claim was due on April 15th, 2003. When did they file it? February 2004. They were 10 months too late. And so they did not get their refund. So part of what you have to do if you're doing a lot of work with non-filers is look at what year, look at what money there is, look at whether or not they've got a refund. Are they going to lose the refund? Story has it that at one point in time, you could apply a return, file a return and apply a refund, and they wouldn't catch that it was out of statute. It doesn't happen very often, if at all anymore. I think that gets caught. Now, I understand, I have been told, I have never done it, that if you have an estimated payment and the return has not yet been filed, you can call IRS and ask them to move the estimated payment. Has anybody done that? I know a practitioner who says it can be done. Brenda, have you done it? You've had it move forward. It doesn't go back. It's not going to go back. But if you have a situation, so Brenda says it has, I've heard from others that it can be done, and that if you get somebody who says no, you just hang up and call back, okay? Because the assisters, especially now in this environment where the assisters, nobody knows, right? I'm sorry, nobody knows. There are a lot of people who don't have the same kind of training they would have had even 5 years ago. And I've been doing this a whole lot more than 5 years. So if you don't get the right answer, call back and see. And it's going to be, I think, in the 6511 series, there's a code section. But there is another practitioner who says she does it routinely. I just have not had occasion to do it. You cannot file the tax return. So you would prepare the tax returns that are missing and see where you are. So if you're missing 5 years, you have something with an estimated payment. You don't need it here, you need it here. That's where you would kick it forward. Good luck if you do it. You can let me know whether it worked or not, because I have not personally tried to do it. Have you? Okay, has anybody else heard of it besides Brenda? Nobody pays estimated take it. Okay, in your world, do they believe in taxes? No, of course not. So they're not even making estimated payments. We're talking about really, really good people are making estimated payments. But it's possible it's something that could benefit you. So I raise it for you. I think this might even be a scenario Frank and I are talking about on Tuesday, and we may disagree a little bit. We'll see. It is possible for Frank and I to disagree. It has happened. So let's talk about the taxpayer's disability, because there's an exception that says if they were financially disabled, then that refund statute can be extended. This particular case on Brosey, it wasn't his disability, it was his mother's he was caring for, and he was an airline pilot, and he was continuing to work as an airline pilot. And we can all make at least a reasonable assumption that an airline pilot functions at a high level, right? So he tried it. He didn't win because it wasn't his disability, and he was not really financially disabled. Non-filing can be inadvertent. Somebody just forgets something, life gets in the way, they just miss a deadline, then maybe they get scared, they miss the next one, or it can be intentional. And the reaction of the IRS may differ depending upon the taxpayer's story. So part of our work, in my opinion, is always to present the best taxpayer story that you can. So when I'm writing a penalty abatement letter, you can hear the violins or you can see the teardrops. I want to put that in the best possible light. Find out as much as you can about what was going on with their lives as to why they didn't. If it's a business, were they impacted by something out of their control? Were they still showing good, reasonable care and prudence in how they were operating their business? The IRS, we'll get to it. IRS has a whole section in the IRM on penalty abatement. Look it up. See what they say you need in that letter and give it to them and make it easy for them to follow that letter so they say, oh yes, we will abate. There are two types of fraud. You can have criminal or civil fraud. There's a much bigger financial penalty for civil fraud. Criminal can put you in jail. So there's the difference between being convicted of 7201 criminal fraud or 6663 civil fraud. Money or loss of privileges and rights. So tax evasion is an actual crime. We are allowed to arrange our affairs in a way that gives us the best tax answer that is possible, but we are not supposed to evade tax. CI, or a criminal investigation, their goal is also to bring in enforcement, but they're the next level. So you've got a taxpayer who has not filed, and the IRS has reached out with the SFR, and they still aren't working with it. The notice of deficiency, they maybe still didn't do anything with that, and maybe it's a really high-profile kind of person, or somebody who has a pattern of non-filing, or repeated IRS contacts. Maybe there is something in that. They have a lot of cash transactions. They make false statements. They're definitely dealing with badges of fraud. And the IRS wants to go after them. That's where they do. And it's in the 7000 series of the IRC. They can't go after everybody. So generally, they're looking at the last 6 years of tax returns. Now, Dave, have you ever seen them go further back than 6? You've done a lot of collection, right? No, you haven't? No, I thought you did. Who does a lot of collection? Yeah, somebody in here does. Yeah, okay, Mike, you do? Okay, Mike's older than you are, so I'm going to give it to him. Have you ever seen, oh, I know. Have you ever seen him go further back than 6 years? Okay, so he has said yes. So give me a little idea of why they went back over 6. So they were trying to contact the taxpayer for a number of years. Let's give them the mic so we can hear it. Go ahead and talk into the microphone.
The IRS kept trying to contact the taxpayer, and he was ignoring them. And the RO refused to accept just the last 6 years. He wanted he wanted to go back 8 years, so he
Okay,
insisted on it.
so the RO wanted to go back to 8 years. Now, he would have had to have approval from group manager to do that because the normal policy statement is 6 years. PK, have you seen anybody go back for more than 6? 6 or more? More? Tell me why.
So I think in the case that I worked on, it was because there were some losses in one of the years, so they wanted a little bit more to.
Okay, so there
to
was something in the
follow through.
tax return that they wanted to have covered in that. Okay, that's a good reason. But generally, they're going to look at 6. Now, I had one time, somebody contacted me, they had not filed for 18 years.
Wow.
And they wanted to get right with all, they were in a 12-step program, and so they were going to get right with everybody, including the IRS. I said, great, you don't really have to file more than the last 6 years typically. Nope, going to do it, going to make it right. Okay, so I gave him the minimum fee of what we would be looking at for 18 years worth of tax filings, and he decided he didn't want to get right with anybody with me because he was gone. Generally speaking, that's what we're talking about. Where I live in California, statute of collections is bigger and longer. And so I've actually had to go to FTB and get handwritten forms downloaded so I could do tax returns that were beyond what I had software on. That's a different place than all you guys live in, right? You're in Arizona, the rest of you are in New York? Yeah, we got a heat advisory where I'm living. We're have temperatures in the high 80s, just to let you know, by the time I get home. My contract, Jim will tell you, my contract always to speak here says no snow until after I've left. He promises every year. You have not been wrong yet, so thank you very much. I've never had it happen in the years I've come to your conference. Thank you. I don't do snow. So there's the policy statement. If they are going longer or shorter, they could. But if they're going to go longer, they usually need group manager approval, but not if they voluntarily file those returns. So they want to file 18 years, the IRS is going to take them. Are they going to issue refunds? No. Yes.
What if, okay, so say,
Let's go ahead and do the microphone so I don't have to repeat the whole question.
so say the person hasn't filed in 10 years, okay? But of that 10 years, he only has 8 years that he really needs to file. So he would have gaps. So he worked 2 years and he has a filing requirement for those 2 years. And then he has a year where he has no filing requirement, okay?
So would you just go back 6, and I'm asking Mike again, or would
Yeah.
you consider the skip and cover 6? I don't know.
I mean, he,
I would go back just to 6.
He would go back to 6 whether it was a filing year or not. And I believe in filing tax returns, even if there is no filing requirement, to put them on notice there was no filing requirement.
oh,
So
okay.
sometimes you might file it without enough income just to get the statute running.
Okay, because I had a guy this year that had to file 6 years of tax returns, but I only filed 5 because 1 year he only made $250.
But if you don't file the return, they don't know that he only made $250. So in a non-filer, like, I would probably file even the year that didn't have that amount of income. I think that's a decision you make. You know, maybe they don't ask, but if you're working with an RO, they're probably going to ask what happened to the year that you didn't file. We have somebody with a question back behind you, Jim.
I haven't seen an SFR in a really long time. I used to see a lot of them maybe 7 or 8 years ago or 10 years ago, but now I'm not seeing them at all. I was wondering if there's a change in IRS policy.
I don't believe there's a change in IRS policy. I do believe there's a change in the IRS that we have experienced. Because remember, for year after year, their budget has been cut, and now they're even more dysfunctional than they were for a number of years. And I say that with all kindness because you can only function when you have proper resources, and they were not funded properly for a number of years. And so I don't know. This is not work that I'm doing a lot of. I have sort of enveloped myself with taxpayers I love. If they don't spark joy, they're gone. Because I'm now at this happy place in my career where I can choose to work with you, or I can say I'm not available anymore. So some of you who are still reaching for it, are you still seeing the SFRs? Are you still seeing that happen with IRS collections? Are they still doing? Not so much? Are you still seeing them? Yeah, he's still seeing them. So maybe it's just your practice or your area. I don't know. Yeah. But I will also say the IRS is not functioning at the same level it did even 10 years ago. It's my opinion. I was on URSAC, like I've been off of it now for 10 years, and there were a lot of changes that were occurring at that point in time. We had multiple commissioners when I was on URSAC that 3 years. And just in the last year, they have had how many commissioners? Like 6 or 7? Do you think that bodes well within the agency when there's a change at the top all the time and then there's all these other changes? So they might go more than 6 years if they have a prior non-compliance history, they have illegal source income, they just want to get that taxpayer before the public, they want some media exposure. There's some reasons why they might. There are reasons why you might see a high-profile case that comes out in April because they want to use it to maybe scare taxpayers a little bit, right? So they may go for more than 6, but your normal answer, 6. That's a good place. And then you make the decision if there was no filing requirement, what you do. If you have taxpayers with international touches at all, the penalties are so big on this. I'm going to say make sure you either know it or you get somebody involved, because it's very easy to not know what you don't know with international. And you have penalties that may be $10,000, you have penalties that may be $100,000. So if international is not your field, and there's a lot of things, it's FBARs, it's whether they have foreign assets, they have foreign pensions, it's, you know, the 5471s, the 8865s, these different forms that have such significant penalties, just be really, really careful or pass them along to somebody who has that expertise. There's somebody either in New York that does it, or there are other people that do. Now let's talk about representing taxpayers, because part of this whole thing is like, all right, well, let's identify them, and now we got to figure out what is we're going to do with them. Because you have two things that can be going with them. You can be working just the preparation, but they might also be going into exam and or collection. So when you're trying to decide if this is a client you want to work with, you really have to look at a non-filer scope. Are they likely to end up in collection also? Are they going to be able to pay what you're coming up with? Are they just coming into compliance, or is there something else going on? Who's asking for the tax return? Have they already received a notice that the tax return is missing, or that there is unreported income? You need to know where you are. Always, when you're doing representation, you get to decide, is this the client you want? You do not have to take every client that comes your way. If it is not within your particular expertise or your comfort zone, don't. All right? You can really get into some uncomfortable, unhappy moments with a taxpayer if this is not what you want to do. I learned fairly early on I did not want to do collection work. I was remote long before it was cool to have an office in the home. And I was a single mom. And the first time I made an adult male cry over his collection debt, I'm like, okay, I don't really like this. And then I had somebody who was walking around my home up and downstairs. And I'm like, okay, that's it. I'm not having people come in. So I chose not to work where I had to be as much face to face. You get to choose. It's your practice. You can decide this is what I want to do. You can decide I'm not the best person that can help you. Mike will take anybody. I know that. So let me give you to Mike, all right? He'll handle it. You guys get to know each other and know who you can refer to if it's something you don't want to do. Always, always, always work with engagement letters. Take a retainer. You want to do pro bono? I will some, but wouldn't I rather be the one making the choice than have the taxpayer just decide that I just did that for nothing? All right, so make sure you're protecting yourselves. I think working and learning this as a younger preparer, that was the hardest thing to do, was to understand I didn't have to take everybody and that I was the one who had to protect myself physically, but also work-wise. I had to collect the money. I had to make sure I was going to get paid. You need the power of attorney form, the 2848. You need IRS records. You need notices. You need transcripts. You need to know who's been contacting them about what. You need the client records. Those may be good or those may be pretty weak. You'll find out as you go. You may or may not have privilege files. There's not a lot of privilege that goes along with tax preparation under Code Section 7525. And remember that even attorneys do not have privilege on tax preparation. They have it, you have it under 7525 as a federally authorized tax practitioner on tax advice, but not preparation. So if there is something that applies with that, it's up to you to keep that information separate and away from the IRS. Then you're going to be preparing an IRS response. Now, with a non-filer, that may be just filing the tax return. And maybe that's all you do. They have the money, they just need the return, it goes off, they pay, that's it. It may also go into other issues, and you decide if that's the work that you're going to continue on with them or not. That tax return may generate communication back from the IRS. So it's possible that you will not be done with just filing the tax return, preparing the tax return. You're always going to be talking with the clients. That's kind of an open circle of communication with them. But also know what your closing strategy is. What is it you're going to do for this taxpayer? Are we done with just giving the tax returns, however many there are, or do they need help through the collection process? Are you going to need to file an offer in compromise? Are they going to ultimately end up in bankruptcy and you're working with an attorney on a bankruptcy? Remember, there's some timing that has to be done, so they haven't been filing returns. That could be at issue. But maybe the ultimate goal, we're going to do an offer. We're going to try to get them into CNC, collection not collectible, currently not collectible status. So these are the things you need to work out. But again, I will say make sure you have an engagement letter and that you are getting something as a retainer, so you are at the minimum protecting yourself. This quote, this is something Karen Hawkins said at a conference long before she was director of OPR. Our job is damage control, not obstruction of justice. And I still like it. We are here to help tell their story. We're not here to stop whatever might harm them. They created the problem. You didn't create the problem. So don't falsify things. Don't make up records. How many of you have, oh, let's not raise our hands on this. How many of you maybe have old calendars or some way of having them track old information? I know somebody who used to retain those. So if they had a client that needed a 2008 calendar, they had one. Not so sure that's a good idea or even necessary now that you can do everything electronically, but don't create the problem. You're there to guide the client, you're there to act as their advocate, and to protect their rights. That's what we're there to do as practitioners. I like to know, why are they coming clean? Is the state after them? My state's pretty aggressive. Is New York aggressive? Is New York more likely to get them than the IRS? Yep. Okay, so wouldn't that be good to know? That you're there really because New York Department of Revenue is coming after them, or for me, the Franchise Tax Board. Why is it they need to file these returns now? If there's something that's coming on with a deadline, you need to know what the deadline is that you're working with. If it's the state or the IRS, I want to see the notices. I want to know how big the non-filing issue is, so that when I get started, I can be thoughtful and I can do this as methodically as possible. I don't like doing things very chaotically. If I've got 5 years to file, I would prefer to prepare them sequentially. I'd like to kind of get a handle on it. Maybe you can't. Maybe it's October 10th and you have a deadline. You're trying to get that return filed by the 15th, or in April, even better, because we can't guarantee that they actually filed an extension. You want to know as much as you can know. Non-filers, you need the transcript. Their memories, probably not good. They may not remember who they were working for, who they were married to, where they were living, any of those things, especially as the years go back further. So get a transcript, because you need to know what's out there anyway. I would not do a non-filer return without a transcript, because I want to know what the IRS knows or has been told about them. So even if it looks like they have a good handle on their record keeping, let's get the transcript. So you want the wage and income transcript to know what was reported. My engagement letter on a non-filer is going to spell out the duties and obligations. I always tell them it's to protect them too. We also know who it's really there to protect, more me than you, but I want to make sure. I've talked about how the fees are going to be collected. If it is someone I haven't worked with before and I have any indication at all they may be not so good about getting me what I asked for, I will give them very short time periods for compliance. So if I request something, they have 5 working days or less to give that to me, because I don't want to be hanging out there. I don't want to find out 3 months from now they really ghosted me. So tailor these. These engagements are more tailored than the general income tax filing engagement, because I'm trying to figure out what I need to do with this taxpayer. So I may put in a very short compliance period and say that if they have not paid within so many days, or if they are not responsive within so many days, that the engagement is ended. Right? I want to, if I've got a retainer, I want to know how I'm going to refill that retainer, how many days. You have to give them notice of it. You have to stay in touch with them. Have that all in your engagement letter. And I would not do this work without one. You may have the tax preparation. You may also have representation. So make sure that your engagement letter says that. Are you willing to take them before collection, before exam? Or is all you want to do is prepare some tax returns? Say that in the engagement letter. If they have an SFR and a notice of deficiency, are you going to work with them on a matter that goes out of the docketed case, that goes before the tax court? Are you qualified to? Do you have the necessary credential to do it? Make sure that is spelled out. They might lose refunds because of timing. I want to say that. They may be a return that is going to require some kind of disclosure. Maybe it's not that I'm just doing a little bit of estimate. Maybe I'm having to estimate really big pieces of information. And I may feel like I need to do a disclosure on that. So I want that in the engagement letter also. So again, it's going to be very tailored on this kind of engagement. It's not going to be the standard one that goes out with my taxpayers and my organizers. It's going to be something different. Get a power of attorney. You know that you can use an 8821 as an authorization, but that does not allow you to represent before the taxpayer, before the IRS. So if you are actually representing, you need the 2848. But what if you just want to see the scope? You could do an 8821 and just see how big is this. Because does the taxpayer necessarily know how many years they did not file? Not necessarily. So you want to perhaps do a discovery on this before you jump in. Again, it's going to depend on what you know about the taxpayer, the kind of practice you have, where you are in the entire process. But you might start there and then go to the 2848. If you're going to represent, you need the 2848. Power of attorney must be signed and dated by taxpayer and the rep. You can't just say all years, all future years. You can in California. I can say all years. Isn't that nice? I can in California, I can file it electronically to their account or my account with my FTB. I can exchange communication with FTB electronically. Isn't that lovely? Yeah. See, that's what I would like to see IRS start doing. FTB went to the whole idea of a callback long before the IRS did. You know, sometimes you win the lotto when you're calling the IRS, and they'll call you back instead of you staying on the phone and listening for the next hour or getting the courtesy disconnect. So that's something that FTB did long before IRS did. So you can go 3 years into the future. You should include all the types of tax that you're talking about, and you should file a separate one for each spouse. And remember, you will be getting separate notices now on each spouse. They no longer consider, even on a joint return, that it's one taxpayer. If you are going to withdraw, you write withdrawal on it. Taxpayer revokes, you withdraw. That's just the language, and that's in the Form 2848 instructions. And knowing this is, again, a sign that you know what you're doing, just like knowing the difference between RA and RO. When you call the IRS, if you are lucky enough to get a person who's going to talk to you, they're going to verify your information and they're going to verify the taxpayer's information. Now, in the time that you've been on hold, you've probably have started working on multiple other things, and you may have already forgotten who you were calling it about on the first time. So I like to have the file open. So when they do come in, first of all, you can write down their name and their ID number. And second of all, you can answer, because they're going to want your CAF number. They're probably going to want your social security number, your name, your address, their name, their address, their social security number. You got to do all of these bona fides before you even start talking about it. So be able to do it without stumbling, and that means having the file available. I like to have a copy of the POA in front of me also. I remember what I said. So I usually have that information all there, but I've probably covered it up with a whole bunch of other stuff before I get the phone call. You have to also be careful that you are not engaging in something that's going to create a conflict of interest. And I'm going to throw this out because I have heard speakers like Karen Hawkins, when she was director of OPR, say that it's possible you should not represent when you have prepared the tax return. So you have an audit notice. Maybe you shouldn't do the representation if you did the return. I'm going to say I don't think that applies always, but if there's an error on that tax return, it's pretty hard to throw the preparer under the bus when it's you. So you may want another step, another person. If you look at a return, and who hasn't looked at a return you did the year before and go, what was I thinking? I missed this? Oh, no, really? We all do it. But if it's a return error that's going to make a difference to your taxpayer and they get audited on it, you may want to pass that return off, that representation off. So think about it even with your non-filer situation. You know, if you know it's going to go into audit, if you know that you are going to have to do a whole lot of estimates of reconstruction. Maybe you limit your scope of work just to the preparation and you have somebody else in your office or another colleague who takes over the rest of the work that needs to be done. We're not trained in conflict of interest the same way that attorneys are trained in it. So sometimes we can miss that you've had a conflict develop. And I've had it happen in an audit case too, where I went further than I should have and didn't see it happening until suddenly there were restraining orders and all kinds of things happening. And I'm like, wow, I didn't see that coming up. Yes, ma'am.
When you're working with estimates that you need to come up with because the customer hasn't given you.
So starting the question, when you're dealing with estimates that you have to work
So when
with.
you're dealing with estimates because the customer hasn't supplied you with documents, how do you have the customer, do you send a letter to them saying, you have not supplied this is what I'm estimating? Do you buy off? Do you agree? How do you handle that?
So we'll talk about that a little bit later because you may have to do some reconstruction. You might have them not by letter, but just give a sign off on them that these are the numbers that we have used. You have assisted me in reconstructing your expenses. If you agree with these that are going to be used on your tax return, please sign and date. I think you have to feel out where you are with them, right? Do you believe the information you're getting? Do you feel at all uncomfortable with the information that you're getting? If you don't feel comfortable with it, then should you be doing the return?
Yeah, that's what I'm wondering.
Yeah.
I've got a customer who would say, yes, I agree with it. And then she'd turn around a week from now and say, I didn't understand what I was signing.
I didn't understand what I was signing. You have to kind of sense where you are with them, right? Okay, so I want to also call this out. When you have non-filers, are they still married to the people of the year of the non-filing? What's the status on the marriage? Does it look good? Does it not look good? Because if you have innocent spouse issues under 6015, remember, one innocent spouse means there's a not so innocent spouse. So if somebody is relieved, somebody's going to have to pay, and you're going to have to see where you are, and that's another possible conflict and another possible reason for either not doing a joint return or having somebody else step in, all right? And you have to be the one who evaluates this with imperfect information because you may not know till the end. You get the IRS records, get the transcript. You can usually ask for more time if they're working with somebody from the IRS who wants a return and they've got a deadline and you've just been engaged. You can usually get more time. If they don't want to give it to you, there's an indication that the taxpayer has not been forthcoming with you and with the IRS and has made previous promises and they have not complied. Because if they won't give you 30 days to do this, there's something wrong. There's something wrong, right? If they have no records, okay, so your business owner, your non-filer, they have no records. Deductions are a matter, the tax court uses this phrase over and over and over again, of legislative grace. And the taxpayer is the one who bears the burden of substantiating their deductions. They have to have some basis for the estimate. The failure to keep records is going to weigh against the taxpayer. Now, what if the records are destroyed? That's a different story. So you would want to know that. You know, that's maybe going to work in a 1-year non-filer, but it's going to be tough to pull off if they've not filed 5 years of tax returns. But you want to know where they are. You want to know how many years, what's the situation, what was going on, why didn't they file? And remember that under the code section 274D, and we're talking travel, mileage, those kinds of things, there are more rigorous substantiation requirements. If the records are destroyed because of circumstances beyond their control, secondary evidence is usually allowed. We all have heard of the Cohan rule, so you know that there can be estimates allowed, but there still has to be something tying that taxpayer to those estimates, and there has to be something reasonable about it. So there needs to be a clear connection between the expenditure and the taxpayer's business. If the IRS requires the records, it may not work. This again is partly where you want the storytelling. You want to be able to tell the taxpayer's story as to why they don't have this. Because it's possible to get an examiner or an appeals officer to buy off on something that isn't technically in the code, but they'll allow it, or you can make the negotiation on it. Once you get into tax court, that's going to be based on law. It's not based on equity, it's based on law. So work with the people you're working with. Try to establish the relationship where you can negotiate maybe or get something, you know. Don't start off, in my opinion, don't start off too hard line. Work with them. See if you can establish some basis for moving along. I like to use the word reconstruction because to me it sounds a little higher than estimating. Still doing the same work, but it sounds like if I'm telling the IRS we reconstructed their records, sounds a whole lot better than, well, we went there and it was up on the ceiling somewhere and the taxpayer said, yeah, that's the number. You will have to decide if disclosure is required. I would not always disclose, but I think there are some situations where you may have to. If the taxpayer here, they did not keep records for cash purchases, they didn't provide sufficient evidence to the tax court to estimate anything, the tax court did not allow them anything. And the tax court does this day in, day out. And they will always work with the taxpayer if there's some reasonable basis. So the fact that they did not work with this taxpayer is an indication there was nothing. So try to have something that you can work with. This case I thought was kind of interesting because they used cash and they had a check payable to cash that went to workers. They also couldn't prove out their build out. It was like a Japanese restaurant, I believe. They couldn't prove the build out, the original acquisitions at trial, but the tax court accepted the last tax return that had been filed that showed a depreciation schedule. So they said, well, clearly, if you're doing this type of restaurant, you have hibachi tables, you have the ability to cook that food, and you have tables for people to sit out, and you have certain other things. So the tax court worked with them and helped them. They accepted the preparer's testimony that those amounts were within the restaurant industry averages. In this case, and the reason I have this case, look how old that is, 2001. Some of you who have been coming to NYSSEA for years and years and years remember that Judge Vasquez did mock trials here a couple of times. You guys remember that? And Judge Vasquez also did mock trials for NAEA at NTPI. And following one of those, he's the one who gave me this case. He was the trial judge on this case. And he said, you know, even if you don't have all of the records, even for auto, if you can come up with an answer, I'd give it. And he did in this case. So that's why I'm putting it in there, because they allowed testimony. They found the taxpayer credible. They allowed deductions. They didn't for depreciation because there was no reasonable basis for that. But the taxpayer was allowed to reconstruct his expenses through other credible testimony and evidence. So what might that be? You have a calendar, and it says who you went. You have a billing ticket, and it says that you did a job here. My son is a concrete pumper, so he is all over Southern California. But he issues billings to either commercial jobs or homeowners that show he was here, 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 here on any given day, week, month, wherever. We could reconstruct mileage. Now, y'all know it's 100% because he's got this big pump on it, and you don't go anywhere with the big pump. But he can reconstruct it. So can your taxpayers. Have a reasonable basis. Here's one case, and understand what they want, and then give it to them. Then you want to prepare the returns. So you need to get the information that might still be missing. You have state income tax. Can you get that from New York Department of Revenue? Yep, you can get it from California. So if you're missing that and they happen to be able to itemize, some of these rules are easier now under TCJA because the standard deduction is so high, they may not be itemizing anyway. But get the information as best as you can, the basis information, the brokerage statements. Get what you can. And then do the tax return. If they can itemize, you can pull it out. You can estimate. You can get things from doctors maybe. You can get things from property tax records. Salt deduction hurt us in California too, so that may not be as useful with TCJA. But the whole thing about a non-filer is you don't know how old that non-filing is. And you have to know what the law was as it changed year by year by year of you doing this tax return. What was the child tax credit that year? It changed a little bit. How much was the estimated, the itemized deduction? Because that changes year to year. So what year are you preparing? Look at all the changes to come with OB3. You're going to have to know what you're talking about. You're going to have to know the law. Bank statements might be the basic set of books for income and deductions. You can get online records most of the time for 7 years. Hopefully that's within your time frame. You may have an issue and may have to pay if you're going for older records. So we talked about Kohan. We talked about reconstruction. Possible that suppliers or vendors may be able to give you information. Do understand that just a credit card statement itself is not sufficient on the face because it doesn't say anything other than you incurred a charge of this amount on this date. So they don't have to accept that. But keep digging. Look for a relevant audit technique guide, because maybe that will help you see some deductions you're not thinking about that the taxpayer's not thinking about. BizMinor and BizStat, those both have been used. In this Bauer case I have, it was successfully used before the tax court. The IRS was using one type of labor. This guy actually was in New York City and he was moving people between apartment to apartment. And the IRS chose a service that, in the tax court's opinion and also the taxpayer's opinion, didn't fully say what the taxpayer was really doing. So the IRS gave him a bigger amount using BizMinor. So this is another place. There are services like this that may help you come up with an industry average. What reasonably, you know they had expenses. Come up with something. We talked about privilege. The thing I want to say specifically on this is if you think you've got a fraud issue on a tax return, you want to stop because there is no privilege on that. And you may want to be hired under an attorney if you think that the taxpayer is in that situation. Then I do the return. Let's say I'm doing 5 returns. And let's say I have no pending deadline, so I'm not trying to rush any of them. But again, I said I like to prepare them sequentially if I can, and then take a look. Do they look reasonable? You guys have been doing this work for a long time. You know when a tax return doesn't look right. You know when something doesn't seem right. How are you netting $3,500 and you're paying a $15,000 a year mortgage interest? You know it doesn't look right. How did you live? What's going on? Let's maybe address that now, because I still don't know the answer. Will a late filed return be scrutinized? I think if it's touching people, it might. If it's going in, now that you can e-file some late returns, if they're not too late, maybe not so much. But if it's going to be processed by somebody at the IRS, I think the odds are greater that it gets higher scrutiny. Don't know that, just my opinion. So I want to resolve it. There's an issue, I want to talk about it now. And then I want to file the returns. Let's assume, again, no pending current deadline that would force you to do something quickly. So you can email what you can. That's our e-file. It should be instead of email, sorry. E-file what you can, and then you're going to have to mail. And when you mail them, don't put them all in one envelope without some separation, because they'll staple them all together and process one, most likely. All right, so if you're going to put them all in one envelope, and I don't ever like that, but if you're going to at least have them in a separate envelope within the large envelope, make sure that you are either sending it USPS with return receipt requested, or you're using a private delivery service, or something where you're going to have some tracking and you're going to have proof of delivery. It's still likely to be a long time before the returns are processed. You can deliver a copy to an RO. I would not file an original return that way, because if the RO doesn't do what they're supposed to do, you still have an unfiled tax return. So even if they're insistent, I would file it. There's even a recent court case, and I don't remember the name of it offhand, but there's a recent court case that says if you don't file it with the proper service center, you have not filed the tax return. Somebody saying the name? CVO? Okay. Okay. So just know, I would not give it to a person, I would give them a copy.
And make sure you say copy on it.
And not for processing, duplicate, copy, something. All right? If you were filing in response to an IRS notice, then you would want to send the tab from the IRS notice so they can track that it was in response to a notice, because otherwise you have a whole different thing that now there's a notice and no response. So make sure they can tie the things together. Again, I like to prepare them in order. That's good, unless there's a current deadline of some course, and then you may have to do that one. Good, thank you. So IRS collection, some of you specialize in collection. There are enforced and voluntary collection processes that are available. The IRS can hurt you, they can levy, they can seize, they can, take money out of the bank account, they can do things like that. You can perhaps get your taxpayer an offer in compromise. You might be able to get them into currently not collectible if they fit, if they have the right kind of information. Decide if this is a step you're going to also do. I'm not going to spend a lot of time on penalties, but we're familiar enough with the main ones. If you do not file the tax return by April 15th without an extension, is there a penalty? Yes. How much is it? 5% per month or partial month, up to a maximum of 25%. If you do not pay the amount due by April 15th, not extendable, you have a penalty, correct? And that one is 0.5% a month for a maximum of 25%. So it's better to file and not pay than to fail to do both. Try to get your taxpayers to understand that. And the two work together for the time period that there's overlap. All right, then there are other penalties when there's, when the penalties get bigger, there's underpayment for not making estimated tax, there's fraud, there's all kinds of other penalties. We have accuracy-related penalties that might apply if you are preparing returns without any basis at all, or if the taxpayer is lying to you, omitting income. It's possible that you may have other penalties. Penalties for negligence, substantial understatement, if they're not reporting all of their income, that one can come to bite them. But it is possible through their first-time abate policy to get relief on certain penalties. And that's fairly easy as long as they have not had the penalty within the last 3 years, right? So if you got multiple years, you're only going to get it on one if they were compliant at the beginning. And then you're not going to get it because they did not file the other returns. Reasonable cause, that's again the letters that I like to write, the violins playing, the tears, you just can see their story. And you can look at IRM, I think it's chapter 20 for penalties. You can see what reasonable cause is and give the IRS that information. What is it that gets you out of a penalty? Let's tell them why it fits. Reliance on the advice of the IRS or a tax expert is a possible way, but only if the reliance on the professional was reasonable. The taxpayer gave all relevant information to the preparer and reasonably relied on the end result. Otherwise, that one doesn't work. It is possible if they just didn't know of the requirement, but they had to have also not had the ability to reasonably be expected to know. If it's a business return, ordinary business care and prudence may be exercised. There may be an unforeseen circumstance. They tear up the street right in front of your business, which heavily relies on street traffic. And so suddenly your business income drops dramatically and you just can't make a payroll tax deposit for a period of time. That might work. But you need the facts. You need to have the skills in talking to your taxpayers to know what their story is and then be able to tell that story. Taxpayer has the burden of proof that the failure was not willful, and their compliance history is going to be part of it. So if they have been compliant for a long time and they just suddenly fall out of step, you've got an easier time than if you have 10, 20, 30 years of non-compliance. Could happen, right? So this is from irs.gov. It's in your materials. So these are the kind of questions you would want to be answering in your letter is what happened? Why? Why did it happen? Have you corrected it? Is it going to continue to happen? Did you fix the problem? Tell them as much as you can so they can look at it and go, okay, we'll abate that penalty. And it is chapter 20, part 20, chapter 1, the penalty handbook. If you haven't looked at it, it would be a good thing to do. Now, what about interest? You can get penalties abated. Interest, not so much. And interest is what, like 7% or something now? It's like real. It's really going to hurt now. So abatement of interest under Code Section 6404 requires an IRS managerial or ministerial act. It requires something on the IRS side where processing didn't occur properly. Then you might get an abatement of interest. So I've seen it where IRS lost the records for 11 years. They got the abatement of interest. The fact that your representative goes on vacation or goes to training and it just takes a while, not going to happen. The fact that it takes them a long time to look at your offer and compromise, you're not getting an abatement of interest. So be aware of what that law is because taxpayers sometimes think you can just get out of the interest as easily as a penalty, and the answer is no. Now, taxpayer advocate, to me right now, they're just as broken as every other part of the IRS. So I use it. I say, okay, it's another resource, but the usefulness is probably not as good right this moment as it has been. But they can handle systemic problems. If you're having problems within the IRS getting things done, it's a possible resource. Right now, we should be pretty close. We've got a couple more minutes. Do you guys have questions? Do you have anything that you want to share? I start on time, I end on time, so I might have to dance for you. We could all get up and do the electric slide. We got a question back over here. I knew that if you saw what was to come, you could come up with a question. You do not want me to sing, just so you know.
I'd rather do the cubic shuffle. when you were talking about revocation of power of attorney. It's a lot better now with the pro-tax account, where you can actually click on a radio button and they'll send you confirmation immediately.
And you actually get out right away. In the old day, when you had to write under the Freedom of Information Act and you had to get the list and you had to. So some of the tools that they have now are far superior, aren't they? It allows you to do things much easier. And you're withdrawing, the taxpayer is revoking. Okay, what else? I have a question back over here. Come on, Jim, let's take a walk. Let's go for a walk. We'll dance as we go. Hang on, do you have a big voice? I don't think so.
It was about a decade ago.
Long
and
time.
This,
You gotta talk into the microphone.
Not just hold it.
I had about a decade ago, and I had people used to run a really great Italian restaurant that had really good garlic bread, and they came to me and said that the 2 owners married and the 3 or 4 adult children that worked there had never filed a tax return, and what was my advice? And I said they should go find a criminal defense tax attorney.
Well, but the question is, why did they not file? Did they not know? I mean, was there a reason? Were they, or did they just not believe that they had to?
No, they were just ignorant.
They were, okay, so ignorance may not require a criminal
and
attorney.
just didn't consider it was a part of their life. Their focus was not on their responsibility.
Their focus was on the garlic bread. So they were busy cooking. They were busy cooking. They were busy running their business. The whole idea of paying taxes, I mean, you know, how can you expect?
Strangely, somehow, they
Hang on, he's
paid
coming back
their
to
New York State sales tax.
So they paid the sales, so they considered that some parts of the tax compliance was important. So is sales tax as nasty as it is in California? Like they'll really come and get you? Yeah, they will in California also. So like you work with the IRS, you pay California, right? You pay New York? Yeah. Yeah, that's, well, yeah. Yeah, because the IRS will work with you. They'll give you a payment plan. They will do things. But you don't want to owe our sales tax people either, because they will. One last thing, and then I think it's just about time.
I believe in New York State, if you don't file a tax return for 3 years in a row, it's a felony.
Oh, I did not know that. So Brenda, one last quick comment?
I did 6 years of taxes for a non-filer. He was a psychologist, but during that time, he had a nervous breakdown and then
Okay.
had drug and alcohol abuse. So I laid on all of that and, in a nice letter, and they abated all the penalties for all 6 years.
Wow.
And he owed money for all those years.
All right, so good job, good job. Again, telling the taxpayer's story is part of what you need to be able to do. If you do it well, you will do well in representing your taxpayers. All right, thank you guys, all have a nice evening. Enjoy the events tonight.